Hi guys, hope you guys are good. Welcome back to today's video where we'll be doing a in-depth video analysis on GBPUSD to get an understanding of what we can anticipate in this week's worth of trading, right? So most of you guys already know that yesterday I did drop a weekly outlook video, right? And the reason for today's video is due to the fact that I felt like I did a bit of injustice when it came to this video, particularly on GBPUSD, right? Because for about 15 minutes of the video, I was analyzing the DXY and I only had 5 minutes left to go through GBPUSD. So everything after that felt quite rushed. And a lot of the insights that I was really looking forward to showing you guys, I really couldn't due to the fact that, of course, I ran out of time, right? So hence today's video. So if you happen to find the information expressed in today's video very valuable, I'd appreciate it for you guys on YouTube to subscribe to my YouTube channel. I'd also appreciate it if you'd follow me on my TradingView profile as well, because I do, release my day-to-day ideas or my analysis on here, right? So an example of that, of an idea that I posted today, is this dollar idea where I was essentially just emphasizing what I was explaining in yesterday's video, right? So if you haven't seen that video, I would recommend that you watch it because you get an in-depth understanding on why I am seeing a bullish draw on the DXY for this week as well as next week, right? So I will attach a link to that video as well. But the main reason why I really felt like I should make this video is due to the fact that on Monday I released this idea where I was seeing a bearish momentum idea starting to emerge on GBPUSD. And of course, this was before that video. And the main aim of that video was also to explain why I was seeing a draw towards these particular points and what engineered liquidity really meant, right? So unfortunately, I wasn't able to do so. So of course, in today's video, I'll be looking to do that, right? So let's get into it. We'll be starting on a weekly time frame. So to give you guys context, we understand that the weekly time frame has been bearish until we took these weekly sell stops over here. We understand that when smart money, the only way they're able to enter the market is through using liquidity. So they need to enter against liquidity, basically. So they, at this point, they auto paid against these sell stops, which is regarded as external range liquidity. So from this point, we'd like to see the market draw towards internal range liquidity, right? Which is regarded at this point as a fair value gap. So this fair value gap is at a premium point, right? So from this point, we see smart money start to distribute within this fair value gap, resulting in this market structure shift to continue to distribute lower, which results in price having to reach this weekly bullish order block. Now, the reason why this weekly bullish order block is a very important point of reference is due to the fact that it has a liquidity void right above it. Now, what a liquidity void is essentially this. Note this last bearish candle over here, right? Right after that, you got about 1, 2, 3, 4 bullish candles, and only after that you got a bearish candle. The difference between this bearish candle to that bearish candle is the fact that you only got one-sided delivery, right? Only buy-side delivery was delivered in that specific price action. That is an inefficiency regarded as a liquidity void, right? So we understand that the way the market tends to move is it's always trying to reach a form of efficiency, right? Which means eventually price action will draw all the way down here as to fill that inefficiency. But now I want you to understand all of this in a institutional point of view or perspective, right? There's two things that smart money is always trying to do, which is order pair, which means enter the market, and book their orders, right? They need to take profits. So they're going to be entering against liquidity, right? So in this instance, they entered sell orders at a deep premium point. That resulted in price having to move lower. It only makes sense. If you're selling at a deep premium, you have to be taking profits at a deep discount, right? So once price reaches this deep discount, it makes sense for them to start taking profits. But one thing that you also need to understand is smart money starts to scale out their positions at a point of fair value. A point of fair value is regarded as inefficiencies, right? So these inefficiencies, once price starts trading in that, they start booking their orders, start scaling out their positions. So this area over here is a point of fair value for smart money to start scaling out their positions. And it's also a point of fair value because it's at a discount for smart money to start accumulating new long orders once that inefficiency is filled, right? So they're accumulating new long orders at a discount price, and it only makes sense if you're if you're buying in a deep discount, it only makes sense for you to start or only take profits at a deep premium, right? So we saw that heavy accumulation of price into the deep premium over here, right? Now, once we reach into this deep premium, we then started to see this accumulation in price, and then we saw a manipulation, right, which resulted in smart money having to take those buy stops. Like I said, they have to enter against liquidity. They order pair, so they had to manipulate price in such a manner as to take these buy stops to enter their order, right? But what is very important that you need to note in this price action is this: the first quarter of the year, right, being January, February, and March, was very accumulative in nature. And note this, it's accumulating at a premium price. Note that because it's very recurring, it recurs a lot. As we continue our analysis, I'll be making note to this idea of how price is being engineered at a premium point. All right. We will talk through what engineering liquidity is when we go into the daily time frame, right? So that you can see it much clearer. So, like I said, the first 3 months was very accumulative and price action, right? And another thing that you need to note, for every 3 months, every quarter, right, of the year, every 3 months, you'll start to see a different movement of price action. It's just the way the algorithm delivers price, right? Every 3 months, the price action will deliver in a different direction. Note that. Just practice it or go look it up. You'll see it's very interesting, right? So price pushes into a deeper premium point. Smart money sells against these buy stops, right? So what I want you guys to note as well, let's just do that. Anything that's above this point is regarded as premium prices. Anything below that is discount prices. So we, in heavy premium prices over here, smart money sells, pushes into the equilibrium point, which is also regarded as a point of fair value, right? That results in smart money having to push the market higher into a premium PDRA, being this premium bearish fair value gap. That results in more distribution towards the downside. Now in what? Discount prices. Note, we sold at a deep premium over there, we sold at a deep premium over here. We are now in discount prices. We are now at a point of fair value because of what? We are in a monthly bullish fair value gap. It's a point of inefficiency, which is a point of fair value for smart money to do what? Start scaling out their position because it's also at a discount. And since we are at a discount price, it's only, it's also another point of fair value for smart money to do what? To buy against these sell stops. That results in the market having to push higher as to reach into our weekly bearish order block over there. Now, if you guys have been following me for these past few weeks, I had been talking through why we want to see a draw into that weekly bearish order block. And then only once we reach there, we'll start to see a movement low of price as to continue the draw to reach these sell stops over here. And then eventually our long-term draw all the way down there, right? Because remember, the daily time frame is bearish. We will get into that. So I want to talk through why I was seeing this point over here as a very strong point of reference, why I was continuously buying the market as to reach there, right? And why I am now seeing a draw towards the downside. So there are three reasons. The first reason is this, and this will tie back into support and resistance traders. I want you guys to, you know, see something which is very crazy, very important, right? And I hope this will also change your perspective as to how you mark your support and resistance. This will teach you as to how to mark institutional support and resistance. So the first thing we're looking at is breakers, right? So we understand that at this point, smart money had to push the market higher. The only way they could have done that is by buying this candle. So they entered buy orders over here, which resulted in price having to push higher as to manipulate all of that, take the buy stops, they enter their selling order over there, and they push the market lower. Price comes back over here, they enter a selling order. Remember, they have the liquidity and power to hedge the market however they like, right? Now, when the market is trading all the way down here, those buy orders that they had initiated are now in loss. What do they need to do? They need to bring the market back to that specific point to mitigate those buy orders and initiate new selling orders, right? So that's why the market goes all the way up there. That's the main reason why support and resistance works. That's the reason why support and resistance works, right? So instead of having to mark your support and resistance in this manner where you're looking for multiple touches, look for that last bearish candle if price went higher to give you a break of structure over there, right? So that's the reason why you're getting a pullback over here. It's essentially buyer's remorse. Smart money is just looking to mitigate those buy orders and then initiate new selling orders, right? As to continue the market lower. That's the first reason why I was seeing price having to pull back all the way up there. The second reason, at this point, this premium PDRA over here, they distributed the market lower, which resulted in what? This heavy displacement lower. What is that? That results in an inefficiency. The same thing we were looking at over here. We had only one-sided buy-side delivery. What are you seeing here? Only one-sided sell delivery. So there's an inefficiency of price action. So eventually you want to see the market pull back as to fill that inefficiency, right? The third thing that I was looking forward, the third reason why I was looking forward to price having to come up here is the bearish order block itself, right? This is a proper region for smart money to look to sell against because of what? It's at a premium point of price action. It's a premium PDRA. So this is also another institutional resistance point which you expect the market to tap into and then reject. And then the fourth reason, all of these things, all of these PDRAs are resulting in premium prices. They're all as resulting in the premium side of the market, which only makes sense. These are premium PDRAs that smart money will be looking to sell against as to draw the market all the way down here, right? And then eventually all the way down there. But now with that being said, let's go on to our daily time frame. Okay, cool. So now before we continue, let me explain this idea of what it means when smart money is engineering liquidity, right? So look at this point over here. When smart money engineers liquidity, what they're trying to do is they're trying to build up liquidity on the opposite end so that they can manipulate it and enter a sell against it, right? Remember, I said smart money can only enter against liquidity. So what are they doing here? They will formulate a retail pattern. Notice the trend line, right, in this instance. So how does trend lines work? You understand there's also proper support here. You understand that support and resistance and trendline traders, their stop losses are going to be at these highs, right? So multiple stop losses at those points because are these points are being respected. What will eventually happen is this last bearish candle over here, remember, like I mentioned, it will eventually become a breaker. Smart money is gonna buy against that to push the market higher and manipulate all those stop losses over there. The main question is, why would they be doing that? They're doing that to build up the liquidity as buy stops to sell against. Remember, for me and you as retail traders entering the market, even if you're risking $1,000 per trade, that's nothing. The reason why your order is filled at that moment is because somewhere out there in the world, if you're looking for a buy, someone is selling. So already your order is filled, right? Now, compare $1,000 to, let's say, for instance, 500 million worth of an order that smart money is working with. Remember, these are banks that they're trying to trade, right? That are trying to trade. They have a 500 million worth of an order that they're trying to fill within the market. They can't just enter it anywhere like how we enter the market, right? Because if they do that, they'll experience slippage. Meaning what? They'll enter their order, the market will go and seek 500 million worth of an order to fill against theirs, right? And that difference will result in a spread. So there'll be a difference between where their order was filled and where the market is currently trading. That huge difference will already put them at a loss. So they can't just enter anywhere. They need to trap us as retail traders and hedge funds, all of these, you know, funds that are also trading trend lines and all of these things, accumulate that 500 worth of an order in terms of stop losses, and then manipulate the price higher to take out all of those stop losses, which will be now considered as buy stops. So these stop losses will be considered as willing buyers for smart money to sell against. So that's essentially what engineered liquidity is, right? So let me delete. Let me just clear out all of these things. Okay, cool. So I'm hoping you understand what all of that is, and you'll see all of this becoming recurring. So that last point over there becomes your breaker. I'm gonna delete that. You already saw where my weekly breaker was, the one that I was specifically looking for, right? And what I want you guys to note is this now. Again, and this all happens in every time frame. Look at this proper support over here, gets manipulated over there. They buy against it, all of that liquidity. They buy against it. They push the market where? Into a premium area, right? They bought at a deep discount. Look, this over here, when price breaks it, market structure shift, price taps into that. What is that? A breaker. The same thing we were explaining over there. Price comes back, that's a breaker in a discount price. What are they going to do there, right? They're going to mitigate the sell orders that they initiated here and accumulate long orders to continue the market higher because it's at a point of fair value to continue the market higher into a premium price, right? And they're only going to be looking forward to taking profits at a premium price. What's at our premium? That weekly bearish order block. Another thing, we have a daily premium daily fair value gap, which is a point of what? Fair value for them to take profits and to look to what? Enter new selling orders. So now you tell me, where's price likely going to go to next? Because they're selling at a deep premium, where are they likely going to go to next? Discount prices. What do we see in discount? A fair value gap, which is a point of what? A point of fair value for them to start to look for what once they reach here to book their profits. So my objective already in price action is to see price draw all the way down here, my first draw, and then to see price eventually reach into the sell stops, and then probably reach this point all the way down here as well. Because I'm extremely bearish on the on GBPUSD because once we hit that point over there, that's when GU became bearish. So this was just a lower low, that's a lower high, and then eventually we're going to form our lower low over there. But with that being said, let's go on to our H4 time frame. Okay, cool. Now I want you guys to note something, right? So like I said, for the past few weeks, I was continuously looking for buying opportunities for price to reach into these premium prices, right? Now look what's residing on the H4 in terms of what's in the premium prices. Look, you have this breaker up here because at some point smart money had to manipulate price higher as to take the buy stops out there. They then did what? Distributed sell orders, right? As to push the market lower. Those buy orders were never mitigated. So what do you see in future? Price comes back, mitigates those buy orders that they initiated to push the market higher, and then they start to do what? Distribute sell orders, right? So that's why I'm seeing a draw towards the downside. Another thing, what's resting in premium prices? Premium buy stops to sell against, right? So continuously, another thing as well. What's happening in a premium price? Look at this. You have this proper resistance zone that was formed in this premium price. What are they doing? They're forcing us as retail traders, especially support and resistance traders, to continuously sell this. We are the stop losses residing at the highs, right? But meanwhile, what are they doing? They're continuously pushing the market into discount prices, respecting order points of reference such as bullish order blocks, rejection block, bullish order block over there. They manipulate price higher. They take out all of these buy stops. They sell against them. So that's why we continuously seeing this idea of having to push the market lower, right? We have these relatively equal lows here, trend line liquidity, which is going to be absorbed, and then eventually we get to our drawn liquidity all the way down there. Please do stay tuned for more daily insights, right? But with that being said, kind regards, the architect.